Hello students, today we talk about the rights to calculation. This is a very important calculation for your unit. Now we have already discussed and this question has already been posted to the canvas. However, let's look into the question together and then we'll solve it together. Now in the screen, if you can see that there are two questions, the question and the solution I have already included. Now let's look into the question first. This is the rights issue example. Example number 2. ABC Corporation is very successful business organization in its own field. The company just paid $1.50 dividend and decided to pay the same rate forever. It is also listed in the local stock exchange and the current market capitalization is $1,875,000. However, the company is currently evaluating a new project which will not only bring positive NPV to the company but will also increase its market capitalization. To execute the project, they required $150,000. The current market rate of return is 8% for the similar types of project. The management is very keen to go for rights issue, which is non-renounceable. To raise the required capital, and the subscription fee will be $15 each. Then the question has been asked, please evaluate the project and do the following calculations. 1. Theoretical value of right. 2. Theoretical value of X right share price at 100% take-up rate. 3. Theoretical value of X right share price at 80% take-up rate. And fourth is market capitalization at 80% take-up rate and 100% take-up rate. Now I would ask the students and the viewer to read the question very carefully before go for the solution. Now the first question is the theoretical value of right. Now first of all, we need to find out the market price of each share and number of new rights will be issued. As if you go to the formula, in the formula sheet said that the theoretical value of right is equivalent to, this is the formula, n multiply Combrite share price minus the subscription price divided by n plus 1. Now this is the theoretical value of right formula. So we need to follow this formula in order to do the calculation. Now as you can see in the formula, it is showing that we need to know the Combrite share price and the subscription price, and n is basically the number of rights required or the number of share required to receive one right. So the market price of the share will be, as you can see here, they're saying that the company just paid $1.50 dividend and decided to pay the same rate forever. Now, as the price of the share has not been given, however, we know from the question that the company just paid a dividend of $1.50 and it's decided to pay the same rate forever. Now this is something like a preference share or a perpetuity, which is it will provide the same rate of dividend forever. And the formula for the perpetuity is basically D divided by R, which is this one. So the price of the share should be $1.50, which is the dividend, divided by the rate of return, which is R, 0.08. Now this is the formula of perpetuity. So if you solve the equation, we find that the price of the share would be $18.75. Now, further, as we need to calculate the number of shares in the market, in order to calculate the number of rights will be issued in the market. So the number of outstanding shares would be the total market capitalization, which has been given, which is $1,875,000, divided by the share price. Now the share price, as we have calculated, is $18.75. So 1,875,000 divided by 18.75, which will give you the number of 100,000 shares. So we know the company has 100,000 shares outstanding in the market. Further, we need to also calculate the number of new shares the company is going to issue. Now the number of new shares, you can explain it in different ways. For example, the number of new rights, we can say that as well, because these are the number of new shares or the new rights will be issued to the current shareholders. Now how we're going to get this number, because the number has not been given. So we can find from here, this question said to execute the project they require $150,000, and to raise the required capital the subscription price will be $15 each. So we know the required amount is $150,000, and the subscription price will be 15 each. So if you can divide it, you can find the number of new rights, and that is what has been given in here. So the number of new rights is $150,000 divided by $15 each, which is 10,000 rights. So now we find all these things. So we now found that the number of share outstanding, which is 100,000. We also found out that the number of new shares or new right, which is 10,000, and then if you divide 100,000 by 10,000, we can find it out that the number of new rights will be 10,000. Sorry, so the number of new rights will be 10,000. So every shareholder who is having at least 10 shares will receive one right. Now there is a small mistake here, so it should be 100,000 divided by 10,000, which is 10 share. Let me change this part as well. So it should be 100,000 divided by 10,000, which is 10 shares, or every shareholder having 10 shares will receive one right. So now we know everything. So we know that, let's write it here. We know that n is 10. We know right share price is $18.75. Subscription price is $15. So we have all this information. So the n is 10, right share price is 18.75, subscription price is $15. So if you put everything in this formula, you will find the theoretical value of right is $3.41. Okay, now that is the solution for the number one question, which is what is the theoretical value of right. Number two question is the theoretical value of X right share price at 100% take-up rate. Now This is a very straightforward question. Remember, now we need to understand that what is 100% take-up rate. 100% take-up rate means that all 10,000 rights will be exercised. So everyone will exercise the right. So it will be taken up by the market. So the full amount will be raised. So how we can solve the problem? So we need to calculate the total new market capitalization. As we know, the previous market capitalization was 1,875,000, that is $1,875,000, and the company want to raise $150,000 more, so that is $150,000. So that is, so if you add the previous market capitalization plus the new market take up, or $150,000, that is the new market capitalization divided by the number of shares. Now, as we know previously that there were 100,000 shares in the market, plus there will be 10,000 new rights. So it will be 110,000. If you put it here, it will be $18.41. Now that is the theoretical value of X right share price. How we are going to get it? Let's look at it. So let's look at the calculator. I put the calculator here for your easy understanding. So we put 1,875,000 plus 150,000, which is 2,025,000, divided by 110,000 shares, 110,000, so which is 18.409090, so which is 18.41. So that is the theoretical value of extra share price at 100% take-up rate. Now the second question is basically asking that the theoretical value of extra share price at 80% take-up rate. At 80% take-up rate, please read this part very carefully. At 80% take-up rate, only 80% rights will be exercised. Therefore, you need to calculate how much the corporation can raise through the rights issue. For example, if the subscription price is $8 and if there are 1 million rights, the company is planned to issue 80% of 1 million will be only $800,000. So 80% of $150,000 will be basically $120,000. Or we can also say that there will be only 8,000 rights which will be exercised. Since it is non-renounceable, now you need to understand the difference between renounceable and non-renounceable rights. If the right is renounceable, then if the holder of the right decided not to exercise it, he can sell it to the third party. In this way, he's not going to lose anything. However, if the right is non-renounceable, then he cannot sell it to the third party, and if the owner of the right decided not to exercise the right, then that particular right will be forfeited. Okay, so we can find it out that at 80% take-up rate, there will be only $120,000 amount will be raised from the market, and only 8,000 rights will be exercised. So 80% of 10,000 is 8,000. So now let's solve the problem again. So we know previously that the previous number of shares, previous number of market capitalization is $1,875,000. Now at 80% take-up rate, the company will raise $120,000 more, and the new rights will be 8,000, and previous market capitalization includes 100,000 shares, so it will be basically 1,875,000 plus $120,000. That is the new market capitalization at uh, at 80% take-up rate divided by 108,000 shares. So if you solve it, it will be $18.47 per share at 80% take-up rate. Let's look at the calculator again. So which is the previous market capitalization was 1,875,000 plus at 80% take-up rate $120,000 will be raised, 120,000 divided by 108,000 shares, because previously there was 100,000 shares and now at 80% take-up rate only 8,000 shares will be exercised. So 108,000, so 108,000 shares. So let's say how much it will be. It is 18.47222. So at 80% take-up rate, the extra share price will be $18.47. Hopefully you'll understand this question. Now the last question is about basically the market capitalization at 80% take-up rate and 100% take-up rate. Now this is very easy solution. Now if you go back to the question number 2 and 3, if you add the top part, which is 1,875,000 plus $150,000, that is the new market capitalization. So 150. So this will be the new market capitalization. There is a small mistake. I'll change it here. 150. So 1,875 plus 150 will be, let's do it together, 1,875,000 plus 150,000, that will be 1,025 or or $2,025,000, and at 80% take-up rate the market capitalization will be 1,875,000 plus $120,000, which is 1,995,000. Now how we get $120,000? Because at 80% take-up rate they can raise only 120,000. So if you add this, the top, these two amount, it will be 1,995,000, and that is the solution for the fourth question. Hopefully you like the solution and it is quite easy for you. If you have any further question, please get back to me.